Ajay, you are overweight bonds, but Dan is underweight on bonds. I know that you're talking about the short-term U.S. Treasuries at the moment, Dan, but Ajay, can you just kick us off with your view on fixed income at this point in time amid the market rout?
Sure. So just to clarify, I'm overweight bonds over global equities. And since I put that out, that trade has returned 15%. Now I got lucky. I did not expect what happened last Wednesday. But, asset allocation is a point of view. And 2 weeks ago, when I put that recommendation out, there seemed to be too much tariff risk in the air. There was far too much uncertainty. Even at that point, the risk was that the United States was headed towards a very, very soft growth patch or an outright recession. And that is why bonds seem to make sense. Not so much because I love bonds, but because I wasn't fond of global equities, where we were at 10, 15% higher. Now, having said that, the bond case squarely rests on the United States and the euro area, both of them going into a recession. If I'm wrong about that, I'm going to be wrong about bonds relative to equities. But honestly, every day that passes, every day that this uncertainty continues, and if, for example, there is a 90-day moratorium, remember, there's going to be a ton of uncertainty associated with that also. So you're going to have 6 straight months of what Dan was saying a little earlier. Businesses frozen, not able to do anything. And that there are going to be costs to that. And those costs are all going to accrue as benefits to the bond market.
Dan, over the last 24 hours or so, I saw so many notes sitting in my inbox talking about how they are calling for short-term U.S. Treasuries. I would imagine it's really the slowing growth and, multiple Fed rate cuts down the road that they see. Are you in that camp?
So I think that there's been a giant recalibration of risk, which has just happened, right? Because from a multi-asset perspective, running portfolios is all about risk budgeting. And it goes beyond just bonds and equities. I mean, look what's been happening in the commodity markets as well. Also concurrently, some very interesting developments there. Where is oil and how does that play into our inflation forecasts? Because if you're going to be choosing bonds or equities between those two asset classes, it's all in the end about your view on rates and inflation. And despite all the volatility that we've seen on tariffs, I'd say we take a step back. Interest rates around the world are coming down in developed economies. Inflation, apart from some short-term goods inflation because of the tariffs, is likely not going to be an issue because inflation is also still pretty much under control. CPI around 3% in the U.S. headline. Again, there'll be some goods inflation from these tariffs, but look at where oil prices are. So overall, I'd say that if you're seeking shelter from volatility in markets, go to liquid alternatives. Take a look at cat bonds, diversify into gold or other commodities, rather than exposing yourself to the risk of either equity or high yield debt because spreads are widening there too.